So here's a summary that ChatGPT gave me. It said over the last 10 years, the gap between how much money investors expect to make from commercial buildings, which we call a cap rate, and the interest that they would earn from safe government bonds like a 10-year Treasury has gotten much smaller. So that gap is called the yield spread. A smaller gap usually means investors feel more confident and think real estate's less risky. So currently, industrial buildings like warehouses have the tiniest gap, and then office buildings have a much bigger one, so they're seen as riskier. So this talks about the yield spreads, looking at it over the last 10 years. Right now, I guess the first place to talk about is what is your feeling in the marketplace or conversations that you're having with people that invest. Are investors taking enough risk for the reward? If the extra money that people are earning from real estate isn't much more than these bonds, mutual funds, is it still worth it? So that yield spread's shrinking, right? I mean, if we're talking about...
That's why we're seeing a lot more people that aren't that interested in just, a low pref of 8%, coming in. They want more upside. They want to see something, or they want to be aggressive and they want to come into a fund like ours where there's an ability to make 14 to 18% based on a higher capital commitment. So they're willing to put more at play to receive a higher return, but they're not necessarily willing to, just receive, the 7 or 8% or 6% pref, because they can do that, better in a stock market or U.S. Treasury bond and things like that. And a lot of people like to arbitrage their lines of credit and have their cash work for them. So if their lines of credit are higher and they're already at 8 and they can't invest at 8, they're almost forced to go to something like ours where they can get the 14, 18%, for that arbitrage. Because if they can pull a HELOC out or they can get, access to capital, even 0% interest credit cards, if you know that you're locking it up for, a 12-month term and you have the ability to borrow at 0% on, 5 cards and get 40K limits. Now you have 200. You can put that to work and arbitrage that at a 15% return. You made 30 grand just by, applying for some applications. I don't recommend it if you don't have the means to pay for it. But if you know that your commitment time is a certain time and you have access to, card stacking and other abilities to unlock capital, arbitraging that and getting those high returns is definitely an advantage.
Do you see people have conversations about investing in real estate nowadays? Do they feel like it's higher risk, lower reward, or do you feel like they still think the ends justify the means?
Well, if you're investing in real estate, you're also going to be purchasing the property and the land too. So it's kind of, if like we talked about in the previous one, if you're buying something at a cap that you think works for you and you can make money on it, when the lease terms out and you can either release it or in turn sell the land or pass it down to your family that you own. I don't think it's super risky in a sense because, like you said, the margins are fairly close. It's just dependent on the type of asset that you're buying.
Volatility of the stock market versus the stability of real estate. Liquidity of your stocks versus the illiquidity of real estate. So a lot of factors going into it, your time, how long you want to place your money and have it locked up, right?
From an investment strategy, yes. Diversification and risk mitigation are always what I lean back to because you want your fast money, you want your slow money, right? And you want your high risk and low risk, money. Right? And so with real estate, for those of you who don't know, there's a certain thing called a 1031. And so you can kind of kick the can per se, meaning you can have income, but you don't have to necessarily pay taxes if you were to sell that income producing property because you can trade it up into another income producing property and then you can depreciate that asset and you can write off any mortgage interest or interest payments against the income that it's bringing in. So it pretty much you can equal it out to a loss. Plus, if you have a heavy year of income, you can use this special tool called cost segregation, where you can actually take all the depreciation and front load it into that taxable year. And so it's just one of those tools that you can actually save. your cash flow, and then you always are going to ride appreciation
You can
for
cost
the most
seg
part.
and you can bonus to do the bonus
Yes, and so
depreciation.
all the benefits of saving your cash and keeping your cash so it's liquid for you to put to work in other things is a diverse strategy. So owning real estate, and then eventually when you pass, you can actually beat the capital gains through the passing of you passing it down to your kids. So it's one of those things where if you never have to pay taxes on any of the gains, and you can offset your income versus the mortgage interest and the depreciation while you're getting it, then that cash that you're bringing in, you could then leverage it in a fund like ours to earn 14 to 18%. And so you didn't have that money if you didn't have real estate, because you would have just paid the taxes because you're in that tax bracket of 30-40% on your 200K earnings.
Phil, I want to ask you this question. Why do you think shopping centers or retail are seen so differently right now? So let me rephrase this. Why do you feel that retail real estate is safe, but office investments have not been safe? What's making people feel that way?
Well, the biggest thing is since the pandemic and the flight from the offices 5 years ago, that people figured out real quickly that they didn't have to be in all of those buildings. And then on top of that, much of that inventory has become obsolete because of technology, and that the buildings exterior-wise look nice, but the guts of the building, as far as somebody actually operating in today's world, doesn't work. So I think most people see that as highly risky, particularly compared to I own a shopping center and got a grocery store and a mix of uses in there. That you're going to have tenants that come and go, but it's much more stable than just really a whole change of how people live their lives. There was some fear some years ago, obviously, that online
I was just going to ask you
that online was going to make a lot of those storefronts,
bricks and mortar was going to die,
to make that go dark. And in reality, it's just proven that you need
you almost need both
brick and mortar presence. Maybe you need a smaller box.
Yeah,
and that's certainly
people still like to go to the store and see the product.
Certainly a big trend in the retail business is going away from category killer box size stuff to the smaller boxes.
Like the online actually affected industrial more than it did retail.
Yeah, ramped up.
It ramped up distribution and that last mile logistics and all that
to get the product to
the store. You order it online, go pick it up from the store.
Mm-hmm.
It helped industrial create more opportunity. And I don't think anybody saw the flight from office that COVID kicked in. Once everyone worked from home, they were like, well, I don't need to go back to the office.
Yeah.
This worked during COVID.
Yeah, that's why QSRs are working so much. There's a thing called Uber Eats.
Yeah. So should we trust just the numbers or the feelings? Yield spreads show how people feel about the market, but what about real facts like rent and expenses? What do you guys think matters more? These numbers that show these things, or do you think it's more of a gut feeling?
Real numbers, rent and expenses. Yeah, the cap rates and yields and whatever. That's kind of a judge of what already happened.
And it's a global look at asset classes by market versus
any grouping. Yeah, I mean it helps you look at all that, but what drives every day is rent and expenses, labor costs.
What do we talk about all the time when we're running pro formas? I mean, we're insulated in Phoenix. Dan Harold's a perfect example of the state of the market. When we talk about cap rates, like we can pretty much agree, but then reduce it based on where the property is located because of supply and demand, right?
Sure. It's a different situation here versus some other places, but it's, and we factor that in. Obviously, when we underwrite things, we're more aggressive in what we think we can sell it for than if, we were
in a rural market.
developing the asset, somewhere in the middle of the country.
If you enjoyed this video, don't forget to like and subscribe for more commercial real estate insights and information. See you next time, and stay hungry, my friends.